This is Doug Tolan with Know Your VA Loan with another installment of our video series. As promised, I'm going to show you mathematically by the numbers why your VA home loan entitlement is far superior than any other loan that's available out there. So let's get started. Make it short and sweet. Numbers, I don't want to bore you too much, but they are important because after all, this is where we pull that money out of our hip pocket every month and have to give it to our lender. And why give them any more than we have to, right? So let's start off with a conventional loan. Everyone's going to tell you a conventional loan is the easiest loan to do out there. There is literally 4 pieces of paper that's different between a conventional loan and a VA loan when it comes to documentation. And that's the hard part about doing a loan. The numbers are the numbers. So that's not hard. It's just that you're going to have to sign 4 more pieces of paper to do a VA loan. So uh, it don't make any sense, and that's an outright lie perpetrated by people that don't want to take the time to learn how to do their job and learn how to do a VA loan. So they'll tell you FHA loans easier or conventional loans easier because that's what they do every day. So that's what they're more familiar with. But we're going to assume that this customer has a 680 credit score because we need to make an assumption so we can base our interest rate, mortgage insurance, and everything on. So we're going to assume this customer has a 680 credit score. And the reason why I choose 680 because it's right there in the middle of about where a lot of people are. And it's a good comparison on these two. So it's the closest I'm going to be able to get these loans to where they're going to be similar in nature. So a 680 credit score is what we're assuming, okay? And that is on the very low end of conventional. Conventional, you need to be a 740 credit score to actually get a better deal. So if you go on the internet and you look at these people and conventional, and they're giving you interest rates and stuff like that, they're always going to base it with 20% down with a 740 credit score because they want to try to get the lowest interest rate possible. So, so with a 680 credit score, your minimum you're going to be able to put down is 5%. 3% down is available on conventional, but not with a 680 credit score. So you're going to need a 720 credit score to do that. So we're going to use 5% down. And the interest rate on this loan, just checked it out, 680 credit score with 5% down, conventional today is 4.625. The interest rate on conventional is different than it would be on FHA or VA because they use tiered pricing. And it's basically 680s at the bottom and it just steps up all the way. And there's even at 740, there's still a small penalty for having a 740 credit score with 5% down. It adds to the interest rate. I can go into interest rates and how they're figured and how they're padded and everything else. But that's a whole video I'm going to do maybe later. But anyway, so $200,000. That would be the sales price of the house with 5% down. That's $10,000 out of the customer's pocket. Finance $190,000 at 4.625. Has a principal and interest payment of $976.87. Now, there is one thing we need to do here to make this work. You're going to have PMI, private mortgage insurance, on a conventional loan. And because this customer only has a 680 credit score and they only have 5% down, it is going to be kind of expensive because there's not a lot of companies that'll even write mortgage insurance for this particular customer. And what I mean by private mortgage insurance is basically the way it works is the lender wants to be on hook for 80% of the loan at all times. Well, this mortgage insurance is insuring that 15% of the loan that you're financing because you only got 5% down. So the loan to value on this loan is 95%. Lender wants to be at 80. That's 15%. This mortgage insurance, private mortgage insurance, and we call it private mortgage insurance because it's actually an insurance policy the lender buys from a private company, and they sell this and they say, basically, if this loan defaults and this lender has to take this home back and foreclose, then this private mortgage insurance company will be on the hook for that other 15% that was not put down. So basically they're going to be on the hook for 30 grand. So for 30 grand, they're going to charge $190 a month until this loan reaches 78% loan to value. So you've paid enough principal down to get to 78% of this 200,000, you're going to be paying that $190 a month. So now that payment is $1,166.87. I'm not getting into closing costs and all that because the closing costs are going to be relatively the same on all the loans. So, and we'll talk about that more here in a little bit. So we're going to push that aside over here. And then we're going to, now we want to compare the FHA. They are the next lending alternative. If you don't have a 740 credit score and don't have 20% down, then FHA is going to be better for you than conventional. I'm going to show you that by the numbers here in a second. So FHA's minimum down payment is 3.5%. Now they don't judge that by credit score or anything else. It is just 3.5%. So financing $193,000. However, the interest rate this morning with a 680 credit score on an FHA is 3.5%. You can see that's quite a difference from conventional. Same 30-year note. What we're going to have to do is go here because guess what? The mortgage insurance on FHA is not as expensive as this conventional loan. Now, the 0.85 I just put in there, the mortgage insurance, private mortgage insurance premium for them is the same for everyone. It's not based on credit score. Just for an example, a while ago when I put the mortgage insurance in on the conventional loan, it was at 1.2%. Well, had this customer had a 740 credit score, that mortgage insurance would have been at 0.66%. So there is a big difference based on your credit. But FHA, it's 0.85 for everybody. Unless you put over 10% down, then it would drop to 0.80. However, remember I just said that you have to pay this mortgage insurance until this loan reaches 78%. FHA, you pay that mortgage insurance until this loan is paid off. That's just the way it works with FHA. All right, so now settled in, everything being equal. Now we have everything equal here. $200,000, 3.5% down, so it's a $7,000 down payment. 3.5% interest versus it's 4.625, and we have cheaper private mortgage insurance. So our total payment here with our mortgage insurance is $1,003.37, where our payment on the conventional is $1,166.87. You can see that big difference. You know, that's $163 a month. Man, that's a water bill. That's a gas bill. That's a, you know, some places that's an electric bill if you got really good insulation. Unfortunately, my house, I can't, I wish mine was that low. All right, so we're going to stick this over to this place here. So now we got conventional, we got FHA. Now I want to show you why your entitlement is a true entitlement versus just a regular loan program. All right, so we're going to take this. This is going to be our VA loan. There's a couple other loans we could put in here and do with, but you know what? These are the three main ones that you're going to run across. So I'm just going to compare these three. Okay, so first thing, same sales price, $200,000. Obviously, the VA, everyone knows, has no down payment requirements. So you're going to finance the whole $200,000. Interest rate, it's about the same as an FHA. From day to day, it might vary just a little bit, but when I say it a little bit, I mean 0.1, 0.05. I mean, very little difference between FHA and a VA. If anyone tells you any different, they're lying to you. I promise you, they're lying to you. There is no difference, okay? Same 30 years, but we get to go down here to that mortgage insurance we've been talking so much about, and we get to say, oh, we don't need none of that. Because as I explained, that the private mortgage insurance was ensuring that overage between 80 and 100%, that in the conventional case is 15%. In the case of the FHA, it's 96. So that's I just lost my train of thought. About 16.5%. So that $136 insures that. The 190 insures the 15%. Well, VA insures 25% of the loan to the lender. 25. So it is a great loan for the lender because they're getting more insured than they would get with FHA or conventional. But the VA does not cause the veteran to pay that monthly mortgage insurance premium. That's what they eat. Okay. So they eat that cost of that. So now comparing these three side by side, because there's nothing else we have to do with the VA loan, that's it. $898.09 versus $1,003.37. And don't forget the $7,000 that they didn't have to part with. No $7,000, and this payment's $105 a month cheaper. And then on the conventional, it's $10,000. But look at this payment. The payment's $250 higher. It might be more than that. Yeah, about 250 and change. $250 higher, and you came out with $10,000. So the entitlement you're entitled to from VA is actually the gift that keeps on giving. It keeps paying. And I will reiterate this another time to make sure everyone understands you can use your VA as many times as you want. You just, under most circumstances, cannot have two VA loans open at the same time. So if you buy this $200,000 house, you use your VA loan, you decide you want a $300,000 house or a $250,000 house, or you want to go back down to a 150, you just got to sell this house, and then buy the new one with your new VA. And it can be done simultaneously. I mean, you don't have to like move out and then rent a place and then go find a house. It don't have to work that way. It can be done simultaneously. Trust me. So, but the main thing I want to stress here, and I know I'm not explaining everything, but I knew this video was going to be a little bit longer than the rest of them because of, we had to do the math. But there's a lot more I could explain here to bet, with closing costs and everything else. Just know there is no difference in closing costs on a VA versus FHA versus conventional. But let me say this: there's no noticeable difference that you're gonna experience. So, on FHA, you're allowed to spend up to the seller is allowed to contribute up to 6%. Conventional is only 3%, but 3% in this case is $6,000, and $6,000 will be enough to cover the closing on the conventional or the FHA or the VA. So that's why I picked that loan amount, because I wanted to put it to where closing costs would be the same. I thought I'd have a little bit more time, but in this case, I don't want to keep this video going forever. So the bottom line is closing costs about the same for all. You should always tell your realtor, I want the seller to pay them. So make your offer accordingly. But if you can buy a $200,000 house with zero money down, zero out of your pocket, if you watched my video about that, then you can live in a $200,000 house for $898.09 a month. That is cheaper than most places you can get for rent. Now, there's some parts of the country, I'm sure rent's a lot cheaper than it is around here where I live in Louisiana. However, this $898 will not rent you a home in Louisiana. You might get an efficiency apartment, 1-bedroom apartment. You ain't getting no 3-bedroom, 2-bath home with a nice yard by a nice school that $200,000 can buy you. So again, your VA loan entitlement is far superior than any other loan out there. Remember, I'm always available to you here at Know Your VA Loans. You can contact me by telephone. You can contact me by email. You can send me a private message on our Facebook page. Bottom line is, I do this because I want to help you. So I'll make myself available to you at all times. If you have a question, you want to go over something someone else has told you, you want to fact check, you can fact check with me. So you can give me a call, email me, or whatever. This is Doug Tolan for Know Your VA Loans, and I'm sure we'll have a new video coming your way soon.